How to invest $1,000 in the stock market 2021. What up, YouTube? It's your boy Jermaine back with another video. Back by popular demand, I thought I would make a video talking about how to invest $1,000 in the stock market in 2021. So here we go. You got $1,000. You want to invest in the stock market. So how do you get your $1,000 from your bank account to the stock market? Well, first off, you're going to need a broker. Now, there's a lot of brokers to choose from, and there's also been some, let's just say it, there's definitely been some broker drama this year. So first off, you got to pick a broker. Charles Schwab, TD Ameritrade, Fidelity, these are your larger traditional brokers. You also have your fund brokers or your millennial style brokers by the name of what do you have? Robinhood, Webull, SoFi, which I don't know anyone who uses SoFi. I've heard a lot of people talking about it, maybe 2 weeks ago. But once again, I don't really know of anyone who uses SoFi. There's also Stash app. You can buy stock with that. There's Cash App. I think a lot of people already have Cash App, so that would be a really, really easy, convenient one because so many people already have the Cash App downloaded on their phone. So you need a broker. Now, you may already have one of these. Like if you have Cash App, you're good to go, So you got $1,000. How do you pick a stock? Because if you're just investing, and if you just got $1,000 to invest, chances are you probably don't know how to invest. So how are you gonna pick the 4 stocks if you don't know how to invest, right? Like, how are you gonna do this? Let's just jump right in the pool with no pants on. So, first stock. Now, once again, this is not financial advice. This is just a guy on YouTube, sharing his opinion. Giving ideas, and you can watch other videos like this one, and you can sort of make your own idea or take the knowledge that you've learned from 4 or 5 videos and come up with your own solution. You are the captain of your ship. Yes. So anyway, a stock to pick. Now, if you don't know anything about the stock market, if you're clueless about the stock market, if you don't know how companies operate, if you don't know if you should pick, Apple from McDonald's, I would say the easiest way to go about this, especially if you don't want to do research, if you're the type of person, you don't want to, do all the research, you just want to you want an easy route, okay? An easy route, and you can still make decent money. Your best bet is to go with an S&P 500 fund. The perfect example of an S&P 500 fund would be SPY. Now, what exactly is an S&P 500? Like, what's an S&P 500 fund? What is the S&P 500? Remember, you're new to the stock market. So if you're new to the stock market, you may not exactly know what the S&P 500 is. Okay, I'll give you a little breakdown. Now, I would imagine if you're starting investing, maybe you've been, following some of the investment drama, but if you haven't, I'll fill you in. Tesla is a company that about a year ago, people were, preparing for Tesla to be added to the S&P 500. So the S&P 500 is a group of 500 companies. And, once you're part of the S&P 500, there's all these funds that follow the S&P 500. And once you're part of the S&P 500, a lot of people invest in you. A lot of retirement funds invest in S&P 500 funds. So you're getting money from a lot of, retirees. You're getting a lot of money from, people going to work every day investing in different funds, and they don't even know what the funds are. It's just the fund that's offered at their job, but, they just keep investing in it, and the money goes to those funds. So an S&P 500 fund is basically about 500 different companies, and it's spread out. If you ever go to Google and type in like S&P 500, you will see the S&P 500 charts. The S&P 500 is pretty cool. It's a very, very simple way to invest. And whenever someone talks about if the stock market is up or down, the S&P 500 is one way you can sort of judge if the stock market is up or down. If the S&P 500 is at its all-time high, that means that the stock market is good. That means majority in those companies in that S&P 500 are doing really, really good. Or if not majority of those companies, the bigger ones are doing really, really good. And it could be a lot of those companies, not doing so good because some of the ones that hold so much of the weight is doing much better, like, a company like Tesla. Or if a company like Tesla is doing bad, it could, pull the weight too, because Tesla makes up a large percent of the S&P 500 because it's divided over 500 companies. I would say an easy stock to pick would be SPY. And this is an ETF. As of the making of this video, it's trading at $393.10. So if you had $1,000, and once again, I would say you should pick 4 different stocks, 5 different stocks if you want. I would not say more than 5. Okay. I would say 4 to 5 if you got $1,000. If you got 10,000, I would say 4 to 5. If you got $100,000 in the market to play with, I would say you can probably go to 10 stocks. Maybe you can go to 10 if you got 100,000. But with a smaller account, I would say stick to 4 to 5 companies. Because the reason why I say stick to 4 to 5 companies, if you get a company, if you have like 4 companies that you're investing in, if you get one of those companies to do a 10x, well, that was 25% of your portfolio. So when that company 10x, you're gonna make a lot of money on that one. But if you got $1,000 and you got 10 different stocks you're in, and if you get one stock to 10x, well, before it 10x, it only represented 10% of your portfolio versus, if you had 4 different stocks, it would represent 25% of your portfolio. If you have 5 stocks, it would represent 20% of your portfolio. So these numbers can really make a big difference if you pick a winner, if you find a winner, And I know some people say like, I really want my money spread out. Like I want my money everywhere. But there is a such thing as being too diversified. Because if you're too diversified, it's like you may get a good runner, but it's not like the base wasn't that big. You had like 10%, or maybe you had 5% position or a 3% position, and then it ran and you just didn't make that much money versus if you would have a little bit larger position. So I would say, go with one of these SPY, or you can pick another ETF. Like you can ETF that follows maybe the Dow Jones. The Dow Jones is another index that represents the stock market. And there's in the Dow Jones, instead of it being 500 companies like the S&P, the Dow Jones represents 30 companies. And Dow companies are even bigger companies, and these companies are very, very important, and they represent a large percent of America's GDP versus the S&P 500 companies, which these companies are typically way smaller market cap versus the Dow companies. Okay, so the next stock. Okay, so first stock would be an ETF, maybe something like SPY, or maybe a Dow ETF, something along those lines. Next stock, number 2, your other 250. I would say go ahead and pick something that's pretty safe. Okay, something pretty safe. So what's pretty safe? Like what is pretty safe? Well, pretty much one of the safest companies you can pick right now. One of the safest companies you can pick right now is Apple. I'm not telling you to go out and buy Apple, but what I'm telling you is Apple is a very, very safe company right now. I mean, it's a really, really, really safe company. So Apple would be a really, really good one. That's pretty much my favorite one. I mean, I would think that would be the safest company. I don't really have any shares of Apple. I think I have maybe like 2 or 3 shares of Apple in one account. But I'm not really holding that much of Apple. And the reason why I'm not holding that many shares of Apple is one of those stocks that it's probably not going to double anytime soon. I mean, it could possibly double, but it's probably not going to double because Apple has more than a $2 trillion valuation, and it's the largest company in the stock market. And that's why it's seen as safe. Also, Apple has a lot of cash. Apple has phones in every other person's hand. So that's why it's kind of seen as a safe company. This is kind of why it's seen as one of those companies that's not going to, drop to the floor. But once again, it's one of those companies that, it's definitely, chances are it's probably not going to double within 1 year. Okay. So a safe company. Another safe company that we can throw out here, I guess maybe like, a McDonald's or a Starbucks. Maybe that could be classified as pretty safe companies because they're on freaking corners everywhere, and so many people go to either McDonald's or Starbucks like every single day in this country. So I would say one of those would be a safe play. Also, out of these four picks, I would say make sure you have a dividend play. Now, with these three companies I just named, Apple, Starbucks, and McDonald's. Once again, all three of these stocks, they're probably not going to, double in value anytime soon. But all three of these stocks do pay dividends. They don't pay that much dividends. You know how dividends, you don't really make a lot of dividends until you've been holding dividends for 10 years. And then it goes from like 2% where you're actually getting like, 20%. But you have to hold it for a very, very long time. So I would say, for the stock number 2, you need to pick a safe stock. So you can pick something along the lines of, McDonald's, Starbucks, or even possibly a utility stock, AT&T or Verizon. These are two utility stocks. They both pay very high dividends, actually. I think AT&T is paying around 7% dividend right now. And if I'm not mistaken, Verizon is paying about a 5% dividend. So those can be pretty safe plays too. Don't think Verizon and AT&T is going away anytime soon because so many people have Verizon and AT&T service. So these are potential good plays. Third stock. Now, for the most part, you pretty much got two safe plays. The third stock can be a little more speculative. Okay. It could be a little bit more speculative. It could be something more like, I would say Tesla, but not necessarily Tesla now because Tesla is an S&P 500 company. And Tesla it has grown so much. And I think that it's going to have a slow period coming up. Tesla has definitely proven itself now. Like they've definitely proven themselves. And, they got factories on, 3 continents that they're working on. So I think that Tesla is not necessarily a good one for this one, but something like possibly a Beyond Meat. Okay, and you guys know I'm a huge fan of Beyond Meat. I'm a huge shareholder. Like I have Beyond Meat in all my accounts. Maybe something like a Beyond Meat, or something like maybe another EV company. Maybe something like a Neo or a Workhorse. Something in the EV space, or another stock in the food space. Maybe something like Tattoo Chef, or very, very good food company. Something a little bit more speculative, something that can run quite a bit. I guess very, very good food company and Tattoo Chef are in a completely different category versus Beyond Meat because those companies can definitely run a whole lot more than Beyond Meat. Like already, because Beyond Meat's already like $180 a share. I think it was earlier today. So maybe like one of those plays, something a little bit more speculative. And for the fourth stock, you can pick between two. Okay, you can pick between another safe stock like Apple, Starbucks, McDonald's, AT&T, Verizon, something like safe like that. Or the other fourth stock you can pick is maybe a stock that is one of those stocks that Wall Street is sort of sleeping on. Now, when you're new to the stock market and you're new to the game, you may not necessarily know what types of stocks these may be, but it can be something that is like something sort of like Dropbox, right? I'm really bullish on Dropbox because I believe that like Wall Street is sleeping on Dropbox, and I believe Dropbox has a lot of potential up ahead, or maybe something like Upwork. Upwork was a stock I talked about like on my other channel. I talked about Upwork about 6 months ago, and I was holding, a lot of shares of Upwork, and I ended up selling out a large stake of Upwork right before it ran off. But I still, was holding some Upwork. Maybe something along the lines of these companies, because these are smaller market cap companies, something like 5 billion, 10 billion, and they still have a lot of growth up ahead of them. Not every company is going to be $1 trillion company. Some companies are going to be around $5 billion, and maybe they'll go to like 10 billion, or maybe they'll go to like 15, or they'll go to 20 billion, 30 billion, 50 billion. But not every company is going to be a 10x, and that's okay. That's totally fine. Another company that I'm holding, and I would sort of put in that category, is the Real Real. The Real Real is another company that I've talked about quite a bit on my other channel, and it's kind of one of those companies that's not too cheap. It's in the $25 mark, just like Dropbox is about in the $25 mark, and it doesn't have a very, very large market cap, and it definitely has some potential up ahead. So guys, yeah, this is the number fourth stock, and yeah. So anyway, I don't know if you guys like these videos like this. I'm just gonna sort of freestyle on this channel a little bit more, and sort of talk about different stocks, and then talk about different ways to like make money and stuff like that in the market, and different opportunities. And there's another SPAC that I'm really, really excited to share with you guys. I'll be talking about in a couple of days. So yeah, just look forward to some more content. Anyway, like, comment, subscribe. Thanks a lot for watching. Peace out.